So tonight's workshop, Advanced Exchange Traded Funds and Portfolio Construction Strategies. My name is Sun Lim. I'm in the investment management field for over 20 years now. And this is a topic that is very close to me at heart because this is one instrument that I've seen it grown since the very first day of my career back in 1993. Before I get started, I just want to emphasize that this is a very important slide. Whatever that we're going to be talking about is for educational purpose only. And more importantly, this webinar itself is not intended as investment advice. Please seek your personal advisor for individual advice concerning your circumstances. Learning outcomes for tonight, we'll be talking about how ETF works and how to take advantage of all of the various advantages. We will also be talking about how to perform effective due diligence using things like exposure, cost, liquidity, risk, and structure. We'll identify how ETFs are expanding into equities, fixed income, and emerging markets, as well as alternative. And then, of course, we will take a look at how big institutions use ETF. We'll look at various strategy and also evaluating risk and return. And also, I will construct and recommend a diversified ETF portfolio. I will actually demonstrate 3 portfolios from conservative, middle of the road balance to an aggressive portfolio. How you can go about construct your own portfolio in a certain manner. All right. So, although the title says Advanced ETF Workshop, but I am also mindful that some of you who will be watching this are really encountering this product for the very first time. So again, I would like to go through what I go through in my basic ETF workshop, and that is that I want to explain that ETF stands for Exchange Traded Fund. It is a fund that can be bought and sold on the stock exchange. So you can buy and sell. The only thing is that you only pay brokerage fees for buying and selling, just like what you would do when you transact a stock, which means that you can transact through a broker as well. It has the same settlement process as stocks that are traded on the exchange. Now, as a fund, an ETF can be made up of a portfolio of stocks, bonds, commodities, and very recently you also see that an ETF can be made up of alternative asset classes. For example, art pieces, wine, and even the very much talk about cryptocurrency can all be packaged into an ETF if there's a relevant index that is being constructed. All right. So key feature. Now, tonight, I will be focusing my attention on the plain vanilla type of ETF, which are most popular. In other words, I'm talking about passive ETF. And a passive ETF tracks an index. It is low cost and it is transparent. Transparency, why? Because investor can know the ETF composition at any given time. It has got tremendous amount of liquidity. Now, 2 sources of liquidity that we are talking about: the traditional liquidity, as what is reflected on the screen, that is the secondary market trading volume, and the liquidity of the underlying assets that the ETF holds. And this is via the creation and the redemption process. Another key advantage, of course, is diversification. Now, ETF, the moment that you buy one share of ETF, it provides immediate exposure to a basket or group of security. So this is a term that we say, instant diversification. And it covers a broad range of asset classes, including, equities, bonds, commodities, and various investment themes, which we will explore later. It is flexible, listed on an exchange, can be traded at any time that the market is open. What that means is that pricing is continuous throughout the day. Cost effectiveness is another advantage that really makes ETF such a popular investment option right now. It is a cost-effective route to gain diversified market exposure. On top of that, the total average expense ratio for equity ETF, we're talking about, and this is based on Europe, 37 basis point versus 87 basis point for the average equity index tracking fund. And if you're talking about an average active funds, those traditional unit trusts that you buy, the average equity total expense ratio can amount to 175 basis point per annum. So I'm using terms that the investment professional use. So some people, when they hear me say 37 basis point, 87 basis point, 175 basis point, what does it mean? Well, if you look into the fund fact sheet, what you will see is on an annual administrative charge basis, 175 basis point is 1.75%. And of course, one of the last key advantage that I want to highlight is this aspect about being able to lend out an ETF units to offset your holding costs. So it's kind of like renting out your holding. And when you rent out your holding, you are able to collect fees for the unit that you are having. So that's a key advantage of holding on to your stocks as well. So one of the things that I want to spend a little bit of time on in this workshop is this thing called the creation and the redemption process. And this is not often touched on in the basic ETF workshop. And most of the time, not understanding this portion will kind of raise a lot of questions in relation to things such as how is it that, an ETF which doesn't have a lot of trading volume can be very liquid at the same time. All right, so it all boils down to this engine, which we call the creation and the redemption process. So let's take a look at the participant involved in this. So we have got the ETF sponsor, the AP, which stands for the authorized participant, the exchange, and then of course the end investor. So I will talk about step 1, which is the creation basket, and then step 2, the creation unit. And these are the two core steps. And in order to understand step 1 and step 2, which is an interplay between the AP and the ETF sponsor, it's easier to explain using this next chart that you see here. Now, this particular flow chart that you see on screen, on the right hand side, we have the authorized participant. And that is where step 1 is involved, right? Step 1, the authorized participant assemble the portfolio of stocks that is determined by the index composition. Now we'll talk about index a while later on, but in this case, let's assume that this particular index is made up of 5 stocks. In this denomination, stock A, B, C, D, and E, right? So what the authorized participant will assemble them and then deliver these stocks to the ETS sponsor. And then what would the ETS sponsor would typically do is to issue what is called share, right? So they issue this creation of units. Of course, this exercise is done electronically. There is, well, we won't talk about delivering actual share certificate involved. Even stocks and share today are all done on the credit debit basis. All right, so the AP, upon delivering the stocks, would receive the ETF share. And this typically is in the range of, let's say, 50,000 shares. But of course, the size can vary depending on how liquid this particular ETF is. Now, this particular process itself is actually not complicated. It is actually borrowed from back in the old days, how commodities are traded. Now, you can imagine, for example, a coffee trader. Now, a coffee trader is like an AP. What a coffee trader's job would do is that they would buy whole sacks of coffee bean from coffee farmer all over the place, all over the world. And then this coffee trader would deposit the coffee bean at a particular coffee exchange in exchange for a certificate, right? So this is kind of where the certificate become very valuable, and its inventory is not held with the AP. Its inventory is held somewhere else at a central location. So that's the role of the ETF sponsor. So that's how the creation and redemption of unit works. So take a look at it again. Now you have the step 1, the creation basket, that is done by the AP. Step 2, the creation unit is done by the ETS sponsor. And once the AP receives the share, he can then sell it via the exchange. And of course, it trades with the end investor itself, right? And end investor can include people like you and me, retail customer. It can also include institutional investor in this whole entire process. All right. So this is a basic breakdown, a slides that actually explain step 1, step 2, and step 3. So if you need a copy of these slides, send an email to the SGX Academy, request for a PDF copy in case this slide is too wordy for you to absorb. All right. So key advantage of this creation and redemption process. Firstly, you minimize trading costs. Now, this creation and redemption process is one major key advantage of the ETF model as compared to the traditional mutual fund structure. Now, I use mutual fund because it's more globally used. In Singapore, we use unit trust, right? Unit trust structure, or we can say it's an active fund structure. Now, this creation and redemption allows ETF to keep their trading costs very low. And since it's the authorized participant that does most of the buying and selling instead of the ETS sponsor, you minimize a lot of the trading costs involved. It is kind of like in-kind exchange for share, right? So an ETF need never sell its holding to meet its obligation to redeeming shareholders. This is one major difference as compared with unit trust. Instead, it simply transfers security together with any capital gains to the authorized participant, which may be a tax-exempt pension funds or an investor that has the ability to offset the gains with other transactions. And the creation and redemption process also ensure that the ETF will trade very close to the ETS net asset value. So in this graph that you see on your right-hand side, you see this oscillating chart. Now, this oscillating chart is up and down above the net asset value, which is a theoretical straight line upward. And you know that this ETF NAV goes up and down, but because of this creation and redemption process, any premium or discount will be taken advantage of by the market arbitrager. Now, why is this the case? Because if there's a premium, straight away, they can profit from the mispricing. And that explains why, if you can see in this chart here, this is the data that's collected by Morningstar. And it shows that, you know, most of the ETF traded within a very narrow band. And we are talking about plus or minus 0.25%, majority of them. And of course, there will be some that are traded to an extent which can be arbitraged away. Those are the issues that will be taken advantage of almost immediately, which will make sure that, you know, ETF will be highly efficient when it's trading, and it will be trading very close to the NAV. And of course, you may say that, you know, there will still be issue that doesn't trade very close to the NAV from time to time. And of course, this does happen, especially for ETF, which has got the underlying assets which are not very liquid. For example, high yield bond would be one such example. Now, high yield bonds can consist of many thousands of issues, and some of them can be pretty illiquid in terms of the secondary market trading. So as a result, from time to time, there might be opportunity for premium and discount. So I mentioned earlier on this aspect called transparency. And because ETF want their share price to closely track their asset value, they actually actively encourage arbitrage activity. And in order to do that, they provide extensive information about the portfolio holdings and their value. And this is done on a daily basis. The listing exchange also publish what is called an intraday indicative value throughout the trading day. The intraday indicative value is actually what is an estimated NAV that applies current market prices to the published portfolio. So in summary, for an ETF product, it is an open-ended index tracking funds. Now, having said that, I want to say that it is an open-ended index tracking funds, mostly referring to passive funds, But there are some active funds which are listed on the exchange as well. And nowadays, as far as, you know, more confusion goes, if you read the newspaper, say the Wall Street Journal or the Financial Times, you would be able to see some player advertising active exchange traded funds, right? So those are more recent development which are not the bulk of exchange traded fund that I will be talking about. Tonight, I'll be focusing my attention on bringing across the bulk of the exchange traded funds which are passively managed index tracking fund. So they are managed by asset managers, bought and sold through brokers, traded on the exchange like any other stocks, settled like any other share on the exchange, can be purchased, cleared, held in a brokerage or custodian account. You can go long or short. When I say long and short, I'm using again another investment terminology. Long means you can buy, short means you can sell short. You sell short without actually having the inventory. All right. It is lendable and marginable. Transparent underlying portfolio is available daily. You have got real-time indicative net asset value, and ETF will be priced around their net asset value due to the creation and redemption process.